Anda tertukar.
My name is Amira Shahmin. Okay, our presentation today is about the introduction and overview of financial market. This is the topic that we will be discussed today. This is our team members, me, Amira Shahmin, Rahia, Aina Farhanis, and Siti Nurul Izati. Okay, let's start with the meaning of the financial market. Financial markets are structures or arenas through which fund flows, which means that financial market is a place where people buy and sell various types of financial instruments like stocks, bond, and currency. These markets help fund flows and move between different individuals, business, government, and other groups. There are 6 types of financial markets, which is primary markets, secondary markets, money markets, capital markets, foreign exchange markets, derivative markets. So now we will look into the primary market. Primary market is a market in which corporations raise funds through new issues of financial instruments. What are the financial instruments in the primary market? Okay, primary market financial instruments are the stocks and bonds that companies issue when they first go public or when they need to raise more funds. These first-time issues are usually referred to as initial public offering. For example, on April 12, 2013, HD Supply Holdings Incorporation announced a $1 billion IPO of its common stock. For the information, issue of additional equity or debt instruments also a part of the primary market. For the example, on March 27, 2013, Dollar General announced the sale of an additional 30 million shares of common stock. This is the example of the financial instrument flow and fund flow in the primary market. It starts with the users of fund, which is the companies or the corporation will issue the new securities such as stock or bonds for the first time. And then they will approach the investment bank that the investment bank will act as intermediaries or underwriters. What is meant by the underwriters? Underwriters is an assistant in finding buyers for share when a company decides to sell its shares. Investment bank also provide the securities issuer with advice on the securities issue, like the offer price and number of securities to issue. Investment bank also attract the initial public purchases of the securities for the fund user. And we will continue back with this. After the corporation approach the investment bank, which also we call as a underwriter, the underwriter will analyze the company finances and structure the offering, including the setting price of the security. And then investment bank will sell the new securities to the initial supplier of fund, which we call investor. And that is the end of the financial instrument flow in the primary markets. For the fund flow, The fund will flow when the investor pay for the new securities to the seller that sell the securities through the investment bank. And then next we will look into the secondary market. Secondary market, that is the market that trade financial instruments once they are issued. Once financial instruments such as stocks are issued in primary markets, they are then traded, rebought, and resold in the secondary markets. Buyer of secondary market financial instruments are economic agents, which is consumers, businesses, and government that have excess fund. And the seller of the secondary market financial instrument are economic agents that are in need of fund. Secondary markets provide a centralized marketplace where economic agents know they can sell or buy quickly and efficiently. And this is the example of the financial instrument flow and fund flow in the secondary market. It is start with the economic agent, which is investor that want to sell the securities. This investor will approach the financial market that act as intermediaries, and this financial market will find the corresponding investor who want to buy the securities. Once the buyer is found, the trade is executed, and the security of the financial instrument is transferred from the seller account to the buyer account. Let's complete the financial instrument flow in the secondary market. And then the funds flow from the buyer to the seller through the financial market. And this is the summary of what is the differences between primary market and the secondary market. In primary market, companies sell their securities for the first time to raise fresh capital. And in the secondary market is more commonly known as the stock market. Here, the previously issued securities in the primary market are bought and sold by the investor. And the mode of investment in the primary market is a direct investment, which are securities are acquired directly from the company. And in the secondary market, the mode of investment is an indirect investment, which are the securities are acquired from other stakeholders, not from a company. The parties in action in the primary market are only investor, company, and investor. Meanwhile, in the secondary market, the parties in action are only investor. In the primary market, the intermediaries is underwriters, and in the secondary market, the intermediary, we call them as a brokers. And the value of security in the primary market is fixed, as it is decided by the company. But in the secondary market, value of security is fluctuating depending on the demand and supply conditions in the market. And that's all for the primary and secondary market. So we will move to the money markets and the capital market. The meaning of the money market is a market that trades debt securities or instruments with maturities of one year or less. Meanwhile, the capital markets are markets that trade equity and debt instruments with maturities of more than 1 year. Furthermore, the money market helps institutions and companies to meet their short-term financial needs, such as managing cash flow, paying bills, and funding payroll. For example, is when a corporation needs short-term funds to cover expenses such as payroll or account payable. The corporation can issue a commercial paper, which is a type of short-term debt instrument that is sold to investors. And the capital market help company raise money for investment, expansion, and a long-term projects. For example, is when a company issue a new shares of stock to raise funds for a long-term project, such as building a manufacturing plant. These are the example of the money market instruments. Um, they are treasury bills, federal funds, repurchase agreement, commercial paper, negotiable certificate of deposit, and bankers acceptance. And these is are the capital markets instrument, which are corporate stock, mortgage, corporate bonds, U.S. government agency bond, treasury bonds, state and local government bonds, and bank and consumer loans. And that is all from me. We will move to the next presenter.
Hi everyone and Assalamualaikum to Dr. and my fellow friends. Next is about foreign exchange market. The meaning is the foreign exchange market, also known as Forex or FX market, is a giant marketplace where currencies are traded. What occurs in the foreign currency market comes out as follows. First, participant. Second, purchasing and selling currencies. And third is rate of exchange. First, participant is the forex market is used by banks, corporations, governments, and investment organization, and even individual investors. The second is purchasing and selling currencies. Individual purchase and sell currencies for a variety of purposes, including travel, international trade, and even trading with changes in exchange rates. The third one is the cost of one currency to another. For instance, you may find out how much RM, how much ringgit Malaysia you need to buy $1 US using the exchange rate between USD and Malaysia ringgit. The supply and demand of this currency cause them to alter regularly. Next. So the first breakout for foreign exchange market is impact of foreign exchange market on businesses, which is companies that operate internationally are exposed to foreign exchange risk. This means fluctuation in currency exchange rate can impact their profitability. Next is foreign currency cash flow risk. When a US corporation or investors receives cash flow denominated in a foreign currency, the actual value in US dollar depends on the exchange rate at the time of conversion. Third one is central bank intervention, government can sometimes influence exchange rate directly by buying or selling currencies or direct or indirectly by adjusting interest rate. The last one is foreign exchange risk management. Companies can use various financial instruments like futures, option, and swap to hedge against foreign exchange risk. Next slide. Okay, the last one for the types of financial market is derivative market. Derivative market means uh, derivative security markets are where derivative securities are traded. These securities get their value from another underlying asset like stock or bonds. The function is the agreement to exchange a set of cash flow at a predetermined price on a future date. Types of derivative: first, future contract, option contract, swap contract, and mortgage-backed securities (MBS). Underlying asset is stock, bonds, or other financial instrument. Next slide. Okay. The types of these four are the types of derivative market. First, futures contract. These are agreement to buy or sell an asset at a predetermined price on a specific future date. Both parties are obligated to fulfill the contract at maturity. The second is option contract. This grant the buyer the right, but not the obligation, to buy or sell an underlying asset at a certain price by a specific date. The third one is swap contract, which means this involves agreement between two parties to exchange cash flow based on predetermined terms. The last but not least, mortgage-backed securities, MBS. Complex financial instrument where multiple home loans are bundled together and sold as a single security. Okay. This is financial market regulation. Financial market regulation refers to a set of rules and laws that govern how financial institutions operate. These institutions include banks, insurance companies, investment firms, and other involved in the financial sector. The main goals of financial market regulation are protecting consumers, maintaining stability, and promoting fair and efficient markets. Okay, first, protecting consumers. These include ensuring that investors are getting accurate information, that their investments are handled fairly, and that they have recourse if something goes wrong. Second is maintaining stability. Financially, regulators aim to prevent financial crisis by ensuring the institution have enough capital on hand to cover their losses and that they don't take on excessive risk. The last one is promoting fair and efficient markets. The regulation help to ensure that markets are transparent and that all participants have access to the same information. That's all from me. Thank you.
Assalamualaikum. My name is Siti Nurul Izzati and I will present about the overview of financial institution. Okay, What is financial institution? Financial institution is an institution that performs the essential function of channeling the funds from those with surplus funds, which is supplier of funds, to those with a shortage of funds, which is users of funds. Next slide. Okay. Next, we're gonna talk about the type of financial institution. Before we going further, if you see there's some of the financial institution I write as depository institution. Okay, what is depository institution? Depository depository institution is a financial institution whose main sources of fund is deposit from customer. Okay, we go back to the type of financial institution. First, commercial banks. Commercial bank is a depository institution that the major asset are loans and the major liabilities are deposit. Commercial banks loan are broader in range, including consumers, commercial, real estate loans. For commercial bank liabilities, it include more to non-deposit sources of funds such as subordinate notes and debenture. Second one is thrift. Thrift is a depository institution in the form of saving association, saving banks, and credit unions. Thrift generally perform service similar to the commercial banks, but they tend to concentrate their loans in one segment, such as real estate loans or consumer loans. Third one is insurance companies. Insurance companies is a financial institution that protect individual and corporates, which is a policyholder, from adverse events. Life insurance companies provide protection in the event of untimely death, illness, and retirement. Property casualty insurance protects against personal injury and liability due to accident, thief, fire, and so on. The fourth one is securities firm and investment banks. Securities firm and investment banks is a financial institution that helps firm issue securities and engage in related activities such as securities brokerage and securities trading. Next one is finance companies. Finance companies is a financial intermediaries that make loans for both individual and business. The difference between depository institution is finance companies. They do not accept deposit, but instead they rely on short and long term debt for funding. The next one is investment funds. Investment funds is a financial institution that pull the financial resources, pull or gather the financial resources of individual and companies and invest those resources in diversified portfolio of asset. The last one is pension funds. Pension funds is a financial institution that offers saving plans through which funds participants accumulate their saving during their working years before withdrawing them during their retirement years. These funds originally invested in and accumulated in pension funds are exempted from current taxation. Next slide. Okay, the next one, this is regarding service performed by financial institution. Service performed by financial institution, we divided into two, which is one is service benefit supplier of fund, second service benefit the overall of the company. The service benefit suppliers of fund is monitoring cost, liquidity and price risk, transaction cost service, maturity intermediation, and denomination intermediation. Service that benefit overall economy is money supply transmission, credit allocation, payment service, and intergener- intergenerational wealth transfer. Next slide. Okay, I will explain more regarding the service benefit supplier of funds. What I show here is only the summarize of it, but I will explain a little bit more regarding it. First is regarding the monitoring cost. Okay, monitoring cost aggregation of fund in and financial institution provide greater incentive to collect a firm information and monitor action. The relatively larger size of financial institution, it can allow this collection of information to be accomplished at a lower average cost. To be more explained is, okay, we can see on equation how can a financial institution reduce the monitoring cost facing the supplier of funds compared to when they directly invest in the financial claims. Okay, a supplier of funds who directly invest in a fund user financial claim face a high cost of monitoring the funds users action in a timely and complete fashion. One solution that can be done to solve this problem is to large number of small investors to group their funds together by holding the claim issue by the financial institution. Then the financial institution group the fund supplier funds together and then they invest them in the direct financial claim issued by the fund users. The next one is liquidity and price risk. Okay, liquidity and price risk. Financial institutions provide financial claims to the household saver with superior liquidity attribute with lower price risk. To be more explained, this is used in addition to improve the quality and the quantity of the information. Financial institution provide further claims to the fund supplier. Thus, they're acting as a asset transformers. What is asset transformers? Asset transformers is a financial claim that issued by the financial institution that are more attractive to the investor than the claim directly issued by the corporation. Okay. Financial institution purchase the financial claim issued by the users of funds and then they finance this purchase by selling the financial claims to the household of investor and other fund supplier in the form of deposit, insurance policies or other secondary securities. The next one is transaction cost service. It was similar to the economic of scale in information production cost and financial institutions size can result in the economic of scale in transaction cost. Okay, by reduce the transaction cost, it not only do the financial institution have a great incentive to collect information, but also their average cost of collecting relevant information is lower than the individual investor. However, as a result to the technology advance, the cost of direct access to the financial market by savers are even falling and relatively benefit to the individual savers of investing through financial institution are narrowing. Next one is maturity intimidation. Financial institution can better bear the risk of mismatching the maturities of their asset and abilities. To be more explained is maturity intimidation is an additional dimension of financial institution ability to reduce the risk of diversification is their great ability compared to the small savers to bear the risk of mismatching the maturity of the asset and liabilities. Thus, financial institutions offer maturity intimidation service to the rest of the economy, specifically by maturity matchmaking, financial institution can produce long-term contracts such as long-term fixed rate mortgage loans to the households while still raising fund with short-term liabilities contracts such as deposit. The next one is denomination intimidation. Denomination intimidation financial institutions such as mutual fund allow the small investor to overcome constraint to buying asset imposed by the large minimum denomination size. Okay, some financial institution, especially the mutual funds, they perform a unique service relating to denomination intimidation due to many assets are sold in very large denomination. They are either out of reach of individual savers or will result in savers holding very undiversified asset portfolio. Next slide. Okay, next slide is service benefit the overall economy. Okay, money supply transmission. Okay, money supply transmission is a depository institution that are conduit through which monetary policies action will impact the rest of the financial system and the economy in general. The highly liquid nature of bank and thrift deposit has resulted in their acceptance by the public as the most widely used medium of exchange in the economy. The second one is credit allocation. Credit allocation, financial institutions are often viewed as a major and sometimes only as a sources of financing to a particular sector of economy identified by society as being in special need of financing such as farming and residential real estate. The third one is intergeneral gener- intergenerational wealth transfer. Okay. Financial institutions, especially life insurance companies and pension funds, they provide savers with the ability to transfer wealth from one generation to the next. The ability of savers to transfer wealth from their youth to the old age as well as to the across generation is a great importance to a country's social well-being. Because of this, special taxation, relief, and other subsidiaries mechanism encourage investment by savers in the life insurance annuities and the pension funds. And the last one is the payment service. Payment service is the efficiency in which the deposit institution provide payment service directly that benefits the economy. That's all from me. Thank you.
Hello. Hi. Assalamualaikum. I'm Rahaya and I'm gonna explain about risks that incurred by financial institution. As we can see, there are eight risks that financial institution face in the various service. Uh, First is credit risks. Credit risk is occurs when someone fails to meet their obligations to their counterparty. And then credit risk can be divided into two categories, which is sovereign risk and settlement risk. Okay, sovereign risk is sovereign risk is a debt that bond issued by a nation government in a foreign currency and sold to the foreign investor, which is sovereign risk is the potential that nation government will default on a sovereign debt that they fail to meet interest or principal payment. And settlement risk is the possibility that one or more parties will fail to deliver on the terms of a contract at the agreed one upon time. Okay, second is foreign exchange risk. Foreign exchange risk happen when financial institution loss in the international financial transaction that may incur due to currency fluctuation. Third is interest rate risk. Interest rate risk is the potential that change in overall interest rate that will reduce the value of bond or other fixed rate investment. Next is asset price risk. That's mean the risk that value of asset will decrease. Factors that affect price risk, earning volatility, poor business management, and price change. Um, Asset price risk happen when financial institution actively trade their asset and liability rather than hold them for longer term investment. So, in this case, they are further exposed to market risk or asset price risk. Next slide. Next. Okay. Off balance sheet risk. Off balance sheet risk is potential financial risks that are not directly recorded on a company balance sheet, uh, which present the off balance sheet risk. Next is liquidity risk, which means a company or individual may not be able to meet short-term financial obligation due to inability to convert asset into cash. And next is technology and operational risk, which is production of financial service require the use of free resources and back office support system, which is labor and technology that combine to provide service. And the last is insolvency risk. Insolvency risk, financial institution may not have enough capital reserve to offset a sudden loss that incurred, and as a result, they may face the insolvency risk for the financial institution. Next slide. Okay, we move to the regulation of financial institution. Next. Okay, so here, we take note one of issues that happen uh when 2000 is happened a financial crisis, which is such a breakdown in the provision of financial service that can cripple financial market worldwide and bring the world economy into a deep recession. Next. Okay, what is financial regulation? Financial regulation is a rules and law firm operating in the financial industry such as bank, credit union, insurance companies, financial brokers, and asset manager that must follow. So financial regulation ni mereka membuat satu peraturan yang financial institution perlu patuh untuk memastikan keadaan financial institution mereka dalam keadaan yang stabil. Macam tu. Next slide. Okay, so why financial regulation important? So here we have to see one example, which is bank failures can wipe out household saving while also limiting a company access to financing. Insurance business failures might leave family members completely exposed. So here, um, we can see how we can apply the regulation in the financial in the problem that happen in the financial institution. Okay, first important is to protect consumers, stabilize trading market, and promote confidence in the financial market by limit exposure and risk that certain key financial players can undertake. Second is regulation is attempt to enhance the social welfare benefits and mitigate the cost of the provision of financial service. And this part is explained in the chapter 30. I can explain as a general for the this topic. Okay, next. Okay, we move to the trends in the United States. Second. Next. Okay, in this table, we can see the changing shares of total asset of financial institution in the United States from 1929 to 2013. Okay, I take two or three example only. Okay, first, for the commercial bank, we can see the commercial bank, the share of commercial bank declined from 54.5 in 1948 to 33.7% in 2030. And then further, the share of thrift institution, which is saving banks, saving association, and credit unions, fell of the or declined from 12 to 6.6% over the same period. And we can see the insurance companies also witnessed decline in their share from 26 to 14.8%. The most dramatic trend involved the increased share of pension fund and investment company and securities brokers and dealers. Okay, next. Okay, so I, I want to explain what event resulted in bank shift from the traditional banking model of originated and hold to a model of originated and distribute. That's mean okay, first, banks gather money from people who deposit with them and then lend this money out to others who need it, like business or people buying homes. And then they expose the institution to potential liquidity, interest rate, and credit risk. And banks shifted to an underwriting model in which they originated or warehouse loan and then quickly sold them. Uh, and then uh, the model have facilitated the change from the originated and hold model of commercial banking to the originated and distribute banking model. Kejap ya. So, in simple terms, as a financial institution adapt to new regulation like the Financial Service Management Act, one big change was how they handle loan. Instead of keeping loan on their book, they started selling them off quickly after making them. This shift, known as originate to distribute, reduced risk for bank but increased risk for the overall financial system. Maksudnya, daripada dorang menggunakan sistem originated to hold, mereka tukar kepada originated to distribute. So that the new system reduce the risk for banks. And then in the old system, which is originated to hold, bank would be careful about who they lend the money to because they help onto the loan themselves. But with the new system, which is originated to distribute, they did not worry as much about whether borrowers could pay back because they were passing the risk into other investor. This means they did not pay as much attention to the quality of loan they were giving out. And for overall, it made the financial system more riskier because the responsibility for bad loans was spread out among different parts of the system. Next. Okay. Second is how did the boom in the housing market in the early and mid 2000 exacerbate financial institution transition away from their role as specialists in risk management and management. Exacerbate ni macam keburukan yang berlaku dalam peralihan financial institution. Macam tu. So okay, after some attacks happened, regulators took steps to stabilize the financial market by making it easier for bank and other financial institutions to get money. This led to lower interest rate and more money available for loans. As a result, people and companies borrow a lot more money, including riskier borrowers who could not get loans before. To attract borrower, banks offered low initial interest rate on mortgage, but these rates would go up later. Bank did not worry too much about the risk because they often sold the loans to other investors. This led to more loans being given to people who might not be able to pay them back, and overall people and companies borrow a lot more money. Next. And the last is, what countries have the most international debt security outstanding? The answer is US. That's why I explain and I choose the US as the example. Um, as the example for that trend the previous part before. So US government has the most international outstanding debt security, and it is tradable and paid to the investor fully. In debt security, the interest will depend upon the repayment capacity of the borrower. That's all from me. Thank you.
Okay, thank you, thank you. Okay, I open to the floor to another student to ask something to the presenter. Okay, very good. You cover, okay, just nice. Around 45 minutes. Okay, 45 minutes. Okay, saya buka pada yang lain boleh bertanya. Semua yang Rahia, you cover sikit tentang risk management tu. Itu dah ada dalam topik lain. Itu dah ada dalam topik paper lain, paper risk management. Tak apalah. Ada satu paper khusus, paper khas untuk risk management in the financial market. Ada satu paper khusus. Tak apa, you cover sikit. Tak soalan. Okey, ada pertanyaan? Boleh share punya slide dan masukkan dalam group. Kalau saya nak, untuk next punya group lah. Cuba kaitkan dengan senario financial market Indonesia lah. Boleh lah. Carilah dalam internet. Kita kalau base pada e-books, all material from America. So cuba kaitkan dengan Malaysia market lah. Yang lagi bagus lah. Ada pertanyaan? Bagus, sempat you prepare. Dan untuk next week pun insyaAllah saya cuba gunakan hotspot lah. Kalau hotspot saya tak apa bagus, tengok macam mana. Asal okey boleh. Sebab sana tak ada internet. Saya kat hotspot ni. Kampung ada, kampung kita tak pasal rumah tu tak pakai internet. Okay, kita internet ni berbayar. Ya, sini laju. Saya 500 MHz 500 Mbps gitu lah. Yang mahal lah. Tapi saya boleh murah. Dulu saya bayar mahal, saya bayar 168. Lepas tu saya nak internet, dia bagi special pula. Dia less discount, dia less lagi harga. Bayar murah lagi, 1 lebih, murah lah. Murah pada tu. Mula 100, lepas tu 100, 300 naik harga. Lepas tu dah cukup tempoh kontrak, saya nak terminate lah. Rupanya dia bagi special lagi. Kita nak kita keluar. Bagus lah. Saya dapat harga berapa? 1 lebih itulah. Murah lah. Dengan kapasiti laju yang tingginya 500 Mbps. Okey lah. Covid saya komah. Office saya bila saya tak sampai. Kabel rosak, malas nak report, malas je pun. Wifi tak sampai. Wifi 1 bar je. Dalam putus-putus. Omah laju. Dah dekat je. Okey, ada lagi pertanyaan? Saya tak tahu lah. Semua ada kat situ, semua ada kat slide tu. Cuma financial market ni adalah satu alat fiskal kerajaan under bank negara. bila melihat berlakunya inflasi, so dia gunakanlah instrumen interest rate dan juga lain-lain instrumen untuk mengawal keadaan ekonomi kita supaya lebih stabil lah. Tapi yang paling kesan, yang paling ketara apabila Amerika menaikkan kadar faedah interest rate, kita akan terkesan dengan teruk lah. Sebab kita banyak berdagang dengan Amerika. So bila interest rate naik, di US naik, mana kos pengeluaran di kita akan meningkat lah. Dan kita terpaksa membayar harga lebih untuk cover kos modal yang kita beli kan. Dan kesan inflasi lah. Atau kita bank negara akan buat meeting setiap 2 bulan sekali tentang kadar faedah BLR, base value rate, untuk menentukan berapa bank kena charge kepada customer, pada pelanggan ke atas loan yang dibuat oleh pengguna. Itu peranan bank negara ke atas fiskal keuangan. Ada pertanyaan lagi? Tak ada, kita stop di sini. Dan grup yang kedua boleh prepare lah untuk minggu depan. Sama pukul 8 saya cuba guna hotspot. Kalau katakan hotspot saya tak function ke apa ke, kita setakat boleh lah. Okay, insyaAllah boleh. Sejam sahaja. Tak lama, sejam sahaja. Sejam atau kurang lah. Tapi ada grup yang lebih sejam ada. Grup yang lebih sejam pun ada grup yang 2 jam pun ada. Saya biar je. Tapi kalau online ni tak, macam dry lah. Tapi cubalah kalau satu grup okey lah 2 jam. Tapi ada grup memang 2 jam banyak, ada satu seorang dekat setengah orang. Dia prepare banyak slide. Saya biar je. Ada konten, ada isi. Kalau tak ada isi saya suruh skip lah. Okay. So tadi pembentan pun okey lah. Yang pertama yang the best markas pagi ni, markas tak sama maka dia bergantung kepada konten konten yang you present dan juga masa. Yang paling tinggi Rahiyah. Yang kedua Siti Nurul Izzati. Dan itu samalah, Tapi tak lari lah sikit lah. Beza 0.25 gitu je. Tak banyak gap sangat. Saya nak cuba bantu supaya kamu dapat markah yang baik lah. Okay. So thank you. Kita jumpa lagi minggu depan insyaAllah, online juga dan hotspot bukan di rumah, di kampung. Okay, ada datang. So thank you. Selamat berpuasa dan tak buka puasa pukul 7.30 nanti. Bukan sekarang.
Thank you, sir.
Okay, baik.
Thank you, doctor.
Thank you, doctor.
Okay, welcome.
Thank you, doctor.
Ya.
Thank you.